Hi, this is Randy Finney with Right Side of the Chart. This is a midday market update for Monday, June 17th, 2019. As we head into the final few days before the big FOMC announcement, let me just reiterate the markets are most likely to remain in a holding pattern. That's low volume sideways trading. Not all Fed meetings are market moving. Some are what we call lame duck meetings. I think I mentioned this last week, where there's virtually a 0% chance of any rate changes, and there's just not enough going on in the economy to that the markets makes a big deal of what they come out and say. But this one is highly anticipated. The odds favor that they hold tight this meeting, probably maybe do a cut the next meeting. But again, that's most important, not just what they do, whether they raise, whether they cut or not, but really what they say. So what happens immediately after is that the market volatility spikes. You're likely to see the market swing sharply in either direction, up and then maybe down and even back and forth. And then usually the dust starts to settle by the next day, Thursday, Friday. But when I say dust settle, keep in mind that we've been consolidating recently. In fact, the market went into a holding pattern a little sooner than I figured. I figured we'd go into a holding pattern this week. Last week we broke down. And there were some technical breakdowns I thought would give us a little more downside before we did that, but no. So we've been pretty much locked here in this trading range now for these are daily candles. So there it is for about a week. And that's what the market does. The market moves up and down. It trends, like we had an uptrend here, and then it consolidates, and then it picks a direction, just like it. Sometimes that consolidation works just as a continuation. You take a little breather, market consolidates, you continue on up, and sometimes you have a period of consolidation like you did when QQQ broke out to new all-time highs right here, consolidated for a couple weeks above the breakout, and then failed. So those consolidations can also mark trend reversals. So that's it. We can and will go either way. It's certainly possible you could, but after an FOMC meeting, the odds of continuing to trade in a tight sideways range are very, very low. So we're going to break one way or the other, and then that's what I was trying to caution you is the initial reaction, the initial pop, even if it's on a daily close on Wednesday, may not be the reaction that sticks. We'll have to assess that as it comes. I'm going to give you levels to watch because what you can do right now, other than trying to overtrade, I'm here. I'll post ideas. I'll give chart requests in the trading room if you ask, my thoughts on something. But I don't typically. This is a time I'd take some time off, like when you have a FOMC meeting like this, and I don't expect the markets to really go anywhere. And any breakouts that do occur, I think, have a much higher rate of failing if they're related. If they're anything that's related to the stock market that trades with it. So therefore, I'd like to pass on breakouts, sit tight. And somebody asked about trade ideas. I might share some setups before the FOMC announcement, but not official trades or active trades. A trade setup, by the way, is just something you're watching in a chart pattern, that you're watching, and that's may break out like a falling wedge pattern, a stock in there. That's a trade setup. An objective trade or trade entry is when you have a chart pattern breakout. And again, during the days leading right up to an FOMC meeting, breakouts have a much higher rate of failing. So better to wait and see if those breakouts stick beyond Wednesday. All right, so that's it. There's the sideways trading. Let's just do a quick overview of the markets. QQQ, which I follow, I track it often. I trade it because it is a very volatile index. It has a lot of tech stocks and it has a lot of concentration, more so than most stock indexes. In fact, more so than any other stock index that I know of. So it's not an accurate index to gauge the U.S. economy or the U.S. stock market. It's I jokingly refer to QQQ as trading XLK with an Amazon kicker. XLK is the technology ETF. I'll show you a chart there, and you can overlay it, and they look almost identical. It'll mirror again. So that's QQQ. But what the stock market is, it's not any one index. The S&P 500 is certainly much more representative because you have 500 companies, not just 100, and you have a lot of much better coverage and diversification among different sectors. There's 11 sectors in the S&P 500. QQQ is mostly technology, although SPY is the heaviest in tech. But QQQ, for example, you don't have any financial stocks. So QQQ lacks a lot of steady Eddie dividend paying stocks, blue chips, certain sectors where SPY has those. SPY made effectively a double top high. I measured it out roughly. I think we moved up a marginal 0.2% above the highs back in 2018. So that's, for all intents and purposes, a double top high or double top failure. And it's the S&P 500 is a 3,000 point index, so a 0.2, 0.2% move above is, again, that's what you would consider an equal high or a double top high. Doesn't mean we can't take it out. And I'll say this: we're much closer to that high again, so we have a better chance in the near term breaking above it than we do breaking down below the recent lows. That's obvious. DIA, this is the Dow ETF, and you can see we have roughly 3 equal highs, but the Dow peaked back like most other indexes. The majority of U.S. stock indexes topped back in 2018 and are still below those highs, including the Dow, which is still, I'd have to grab it exactly and tell you that the Dow as of today is about 3%. So it's within shooting distance, a good day or two away from popping above there if it wants to take out those highs. Then you also have the mid caps, MDY, well off their highs from 2018. So here's a index or a sector of the market, or subsector, if you will. These are all the mid cap stocks of mid cap 400 index. MDY dropped about 24% off the 2018 highs, and it's still down about 7% and below those highs. And small caps, they peaked back in 2018 as well, also dropping about 25% or so, maybe even a little more. And to this, 27, closer to 30%. And to this day, they're still down about 12% off the highs. So that's kind of the bigger picture, and that's why I'm of the mindset, as are some other people, that the stock market, and again, the stock market, not the S&P or anyone, not the QQQ, the entire stock market may have peaked back in 2018 because it's simply a collection of its parts, and that's all the small caps and mid caps, not just the large cap stocks, the majority of those index being below. So we'll see what happens there. So let me get back to giving you levels. QQQ, let's focus on the 60-minute chart. And again, the 186 level to me is pretty big. QQQ should remain above that ideally to keep the bearish scenario intact. And then you can see some levels here that are marked. If we do go down, all the different support levels there. But I'll tell you, at this point in time, we've consolidated enough on the daily chart, or these intraday charts, and I focused a lot on that. We should jump back to the daily charts. I think those are the targets we should really focus on, the big levels there. And I don't know if I've updated this in a while, but these are the caution levels. Anything down to these white lines, as I said back here, correction was certainly baked into the charts here. We had this cleanup trend line, the rising wedge, the divergent high, the failed breakout there in QQQ. And I would want to believe that even the most ardent bulls, at this point in time, after such a run-up, those that are looking for, the economy to continue to grow throughout 2019 and into 2020, those that are looking for new highs in the market this year, they believe that the 2018 and 2019 highs will be taken out in QQQ. Those bulls, I would imagine, were looking for at least a correction back here. And that's what we had. And I said that may be all that proves to be. You can't say definitively. You can have your opinions like I do, but you can't really say this is anything more than just a healthy correction in an ongoing bull market. Nor can you say that, like I showed you on all those daily charts, that we are not in the early stages of a bear market that topped back, to 2018. So again, say what you will, but what happens over the next who knows, couple weeks, couple months here, will tell us. If we start breaking out those other indexes that haven't taken out their 2018 highs, the Dow, the mid caps, the small caps, if they start taking those out, obviously, then there's more life to go in this bull. But as of now, that's not the case. So these are levels, and 160 is my yellow line, where that would be a pretty ominous sign to break that level. And if, of course, if we go down here, orange is even more significant, and red, that's about 152.51. If that level goes, and then I think we just waterfall sell off. I think we'll slice through the 2018 December lows, where I think that some that that are bearish are calling for a test of those lows. Again, I think we'll probably just go on right through there if these lines are taken out. And there's SPY, different levels marked as well. I've had this minimum target here for a long time. I'll probably get rid of that word minimum target, but it is a support level. And again, it's a support level I think would just be, again, a healthy correction within a larger bull market if there's more downside to come if we got down that level. Now we've got a way to go. Let's just see how we break from these current levels here on Wednesday, and we'll go from there. And again, if I have some trade setups, I may throw them out contingent, with the entry being contingent on what we see happen after Wednesday. In other words, usually on a trade setup, like let's say it's a break of this trend line, the short entry will be here on a breakdown of the trend line or a back test of the trend line. And we can even identify that in advance because we know where the trend line is. So sometimes I'll put trade ideas out there, give you the targets, the price levels, even suggested stops, although those are usually contingent on the exact entry price. Why? Because if you have a target down here and you want to set your stop roughly in line, about using a 3-to-1 or better risk-reward ratio, depending on how far your price target is. So that's where we're at right now, and we'll again, I'll update. I'll be all over the markets on Wednesday and going into Thursday, and we'll try to gauge, which way this thing's going to go and what are the best trade ideas to jump on. Any of the trades that we have out now, do we need to cover those? Maybe revise stops. As of now, I'll leave everything as is. I'll make a decision before Wednesday whether to temporarily suspend any stops on any of the trades or not. Here's some near-term levels to watch. I posted some. I'll get to QQQ in a second. This is SPY. SPY has this is just a 5-minute chart we're looking at here, but you can see about 289. We'll call that 290. You can see resistance on SPY right now, so that's a level to watch. It popped it intraday briefly, but fell back below. So we have a couple reactions there, reactions there, and a little false breakout. So I think it's a level worth watching right now for SPY. As are any of these levels here, 289.22, you have a minor uptrend line here. And then QQQ, I posted, QQQ since Tuesday has been in this range right here, bounded by these blue lines, 183.80. Let me see if I can grab that. 183.80 down to about 182. You can see we go back here till Tuesday, and that bounds that. So I posted this 5-minute chart earlier today with the potential trading up. You can short if we bounced up to 183.80. We were almost there, and we did hit it, popped just above it, and then I had right above there, I had the next resistance level. I think it's only 0.2% below. So I think a stop on anywhere a 5, 10, or 15-minute candlestick close above that level. Why do I say that? Well, you can see it has come into play since I posted that chart. We've had several. These are 5-minute candles. Several 5-minute candles just touched that level. So we had a perfect tag there, high 184.23, exactly on that resistance level I laid out earlier before it was hit. Then 184.25, 2 pennies over it. So what will happen is when you have a resistance level, they're going to poke it. They're going to poke it on the 1-minute chart. But if you are looking to go long, which I wouldn't be, or looking to short today for a pullback towards the bottom of the zone, because that's kind of the trade idea there, is to here, let me grab that tool here, to short up here, around the top of the zone, and swing back down to any of these support levels, and possibly even the bottom of the zone before Tuesday, or I'm sorry, before the FOMC announcement on Wednesday. Now that's for those of you that have traderitis. I'll keep the trade ideas coming. This is more of a day trade or short-term swing trade if you want to take it home. But that's it. Anytime you have a trading range, again, box it in like that, where you can trade off of the MO until the range breaks is to go long at the bottom or cover your shorts on the bottom, and then swing it long up to the top and then reverse and go short from there. And again, sometimes you want just these quick trades in and out. Don't swing for the top and bottom of the range in one day. It may take a couple days to get up there so you can swing down to any of these targets. And again, that's active trader stuff. But as I said, there's a good chance you get whipped up to pieces in the market right in front of an FO. As I mentioned, a lot of traders don't want to position right in front of it. You can see volumes dropping off. Look back here, see how big the volume bars were? Here, let me try to show you a line there. Tool, let me grab a line tool, change the color here, and show you we had bigger volume back then. This is normal volume. But look, lately the volume is really tapering off. Why? Because who wants to take a big position in front of a big market moving Fed announcement that's either going to go for your position or against it, or worst case scenario, like I said, and the reason that I will sometimes suspend or widen my stops, you're probably going to get this. This is tight price compression. It looks big here on a 5-minute chart, but when you zoom out here, to the 60-minute chart, you can see it's relatively tight price compression. And after that Fed meeting, this market can really perk up here. So be in store for anything, at least volatility in both directions come Wednesday. Here's the VIX. The VIX and the stock market go hand in hand. They tend to trade inverse. So we have a long position on TVIX, which is essentially a short on the markets. And when you look at, let's just compare all here. I'll put up the NASDAQ composite right there in blue. It's that simple. There are going to be day-to-day disconnects, but for the most part, as you can see, when NASDAQ is rallying, the VIX is falling, or at least holding its own down to a bottom of range when you get to support. That's where I like to buy it, at support. And then you can see right here, if you can see the blue line, there was a sharp correction in the NASDAQ, VIX exploded. There was another correction in the NASDAQ, VIX exploded. So you can see these are inverse charts. NASDAQ topped, corrected here, from that point to that point, it went up there. And what I mentioned in the trading room today is you have to know your security, know what you're trading. I try to do my best in conveying my thoughts when these trade ideas go out there, that the VIX itself, remember TVIX is tracking short-term futures on the VIX. The VIX itself is probably the most volatile index that I know of. It's not the stock market, it's a volatility index, as that name should tell you right there. In these candles, it is more than common to see the VIX move up 20, 30, 40, even 50% in a day, and it does it several times, many times each year. So it's not a rare phenomenon to see the VIX shoot up double digits in a single day and then do it again and again and again the next day. So when you trade TVIX, now you're leveraging up the VIX by 200%. It has 2 times leverage. And these might look like any other stock chart to you, but see, I use log scaling, and you have to use it on a chart like this. If you don't, it tells you a different story. You can't hardly even make out the prices because these swings are so big. This puts all the candles in percentage terms. And you can see right here, there's just in one day about a 90% move in TVIX. So as I say, know your security, know the volatility involved in each one, and how much it can go up or down. So, and I say that because a couple of comments, today the TVIX is down 1.72%. If you back out the 200% leverage, that's down less than 1%. And you need to factor in that leverage. Then add to that, I took the position size down a lot more because of the volatility, the volatile nature of the VIX. So to me, in my head and on my account, this trade is flat. I gave you a quick target. What happened here is when I added it last week, based on that breakdown, remember on the futures, right here we had this beautiful little uptrend line, well defined, and we had nice clean negative divergence right there. There was a price channel, there it is. That channel ended with a divergent high. There's your negative divergence right there on NQ, the NASDAQ 100 futures. The S&P 500 futures had it too. We had a breakdown, and it did play out. From the divergent high, we started moving lower. We broke down from the wedge, continued lower. I expected before we got locked into the Fed sideways grind, I thought we'd get a little more downside. That's where I thought we could get a pop up, hit that T1 target. For those who want a quick trade, get out. And but what happened is we didn't. The market started grinding around a week ago. And I guess the Fed meeting is that big that we had the breakdown here, but just nobody wanted to position in front of the Fed, even on that clean breakdown there. We've just locked in sideways. So this is not bullish. This is not bearish. This is going nowhere. And same story on the SPY as well, or the ES. So going back to that chart, that's it. This is still the the official stop on the trade, the max stop. And I'll tell you, this thing, and I said it in the trading room, come Wednesday and probably Thursday and then again Friday, if you are feeling pain on a 2% move in the VIX or TVIX, then you probably should get out right now, because I can almost assure you on Wednesday afternoon, after 2 o'clock, between 2 and 4 o'clock, this thing's going to shoot up. And I would be surprised, in fact shocked, to not see this up or down at least 10%. And I wouldn't be at all shocked or surprised to see it up or down 20 or 30%. And so if that is not in your comfort zone, now you can stop out intraday, you can stop out however you want, or you can, same story. If you need to be quick on this too. When volatility spikes, you got to get in, get out. So these are the targets. I'll update my thoughts after the meeting goes. As of now, I'm leaving these price targets in place. This is still a potential price target. I'm leaving that stop in place. I'll make the decision whether to pull that or modify it or anything before the Fed announcement on Tuesday. GLD, I still very much like gold, or this is GC, the gold futures contracts. Here, let me center that chart for you. There it is, GC. 60-minute chart, we put in a divergent high, so I've been a little cautious on the entry. I want to get an official entry. We were long gold earlier in the year, I think it was, officially, but I've stated this one, just intermediate long-term looking good. There's some developments on the US dollar that I've been watching, and I actually like that. I'm going to get to that chart in a second. Just want to put, we had a little weakness here, which is probably, I think any pullback now is a buying up in gold. But again, just like the stock market, the Fed can change everything on Wednesday. I am still favoring, I'm still bullish gold. I'm talking intermediate, longer term, bullish gold, bearish equities, bullish certain agricultural commodities right now. Same old stuff I've been for a while. And let's look at the US dollar euro chart, because that is the big driver behind gold, at least for me. Or you can look at a US dollar index. So we had the breakout. Remember this bullish falling wedge that I've been tracking for a long time, waiting for that breakout. Broke out, but I had some concerns because we had resistance there, which we popped a little above it, but pretty much failed there. Came back and we back tested. So this actually looks good for gold because the euro has done a breakout of the pattern. A back test, so far successful. It's 3 different days it's held on there. And so I think we'll resume on up. I think after the, and we'll probably take the FOMC meeting to be the catalyst for a thrust up to this next downtrend line. And then you can see I have a support, some resistance levels there. And ultimately, I think the euro is going to work its way up here, the euro-US dollar pair. It's in the coming months here, not very long. I think once the FOMC meeting's out of the way, if things go as I suspect, we'll probably work our way up there at about that 118 level, and that should be really good for gold, because that means falling dollar if the euro's rising, and that would be bullish for gold. So we'll continue to watch that. I need to see an objective, nice clean objective entry for gold. Until then, I say the best thing to do is just scale in. If you already have positions, you want to continue to add, you haven't built up a full position yet, just buy on pullbacks. All right, that's gold. Here, let's look at the Joe daily chart. That's Coffee ETN. We have an official trade that went up, quickly rocketed up, hit our second target, at which point, put up some charts. We had divergences and at resistance on the futures and everything else, looking for a pullback, and that's what we had. And we, as I showed on the futures today, pulled back to support. I have a little wedge pattern going, so I'm leaning towards the next thrust up starting from about these levels now. And remember that coffee futures trade, they're quirky. They stop trading, what is it, 1:30? I'm trying to get there's a lot of different futures out there. They don't trade the regular hours that the index futures trade. They cut off earlier in the day. Maybe it's 2 o'clock, 2:30. I'd have to look at that. But I also want to show you a long-term chart, a couple long-term charts here. Okay, this is the bigger picture stuff, and this is the stuff I try to, I shared this chart several times, and it helps formulate, why on coffee I'm still, we had that sharp run up and followed by a sharp correction, but why I'm still looking for leaning towards more upside here on that trade. This chart goes back for decades. This goes back into the late 90s right here. It's a long-term chart of coffee futures. And what you can see here is pretty simple stuff. You don't get them often. You have to sit back and be patient, but you get these divergent lows right here. There's a divergent low in coffee coupled with a nice downtrend line. You can see you have these trend lines. And so you trade off those. You had a divergent high there, big correction. So what I want to do is measure out divergent high, divergent low, divergent high, divergent low. So you could both divergent lows are bullish. And then of course, you can get a divergent low and it can continue to be a divergent low. I pointed out a divergent low, I believe, in coffee back there. And we did. We got a nice pop right there. But we put in another low. Sooner or later, one of those pops like this or this or this will play out for a trend reversal, most likely. And what I wanted to show you here, let me clear out these annotations. Let's do that. And measure out the moves from these previous divergent lows. If I drag that up, you should see a pop-up box in percentage terms. Up to that divergent high, that was a 300% rally. Next divergent low was right here. If I grab from there, up to that divergent high was a 123% rally. And so far, we have this divergent low here, breakout right there, and so far we've rallied only about 22, I don't know, 22% or so. These are potential targets. So again, maybe it's a false start and we go and continue to make another low and extend these divergences, or maybe it's one of these. And right now, I'm leaning towards one of these much bigger moves. And that's why coffee is not just a swing trade, but it's also a long-term trade on the site. So many ways to trade those, all the trade ideas. Active traders, and I try to share my thoughts if a target's hit, if I have a strong opinion on a pullback or a continuation. Sometimes we'll hit a target and I'll say I favor going through that target, based on the charts at the time. But in the next case, looked like a reversal is likely, and that's what we got. So, an active trader, even a long-term trader, could have booked profits, partial or full profits, and then recycled back in on a pullback. Pullback to T1 was an objective entry, but it didn't produce a bounce. But we still have an objective entry here with the futures being at support. Okay, and another ag commodity we've traded. We had recently closed out an active long on wheat, but I also mentioned it as a long-term trade idea. Very promising. When the story on this chart, forget about the divergent lows for a second. They certainly help, but we have here, same thing. This chart goes back decades into the late 90s there. And what I've done, and I've maintained this chart for years. So I've shared this chart, shared these setups before. I'm circling every single oversold level that we've had, and that is a hit of 30 or lower on the RSI. So without exception, we had here a 52% rally, 45% rally again off these lows, 36% rally, 46% rally, and so far only about a 20, we'll call it almost a 30% rally. We caught most of that rally, got out on the initial pullback. It's come back up. I mentioned as a re-entry recently. I think it's going to continue up. But what's my point here? Well, look at the averages. So we're probably averaging, at least 45% or so on the initial thrust up. Now that was, again, this one went up 52% here, but before all was said and done, it didn't top out right there. Again, there was an oversold reading, a 45% rally. If you held on to it, there was more to come eventually. So, and then the other thing too, and the basis for the trade, by the way, initially was this long-term uptrend line right here. We can see the trend line that I have that comes all the way off lows going back into the 90s. with a lot of reactions. So every time you stepped in and bought wheat off this trend line, you had a nice swing trade opportunity. So that was the basis for that trade. And let's look at it now on the ETN. Can trade futures or the ETN. So there it was. We had this T3 was right here, and it was hit right there almost to the button, pulled back to T2, at which point I said that was an objective long re-entry to buy back in. And again, I mentioned it being bullish on with the futures, and so wheat's continued on up here. And it's hit this resistance level on wheat, but futures look a little better there. Let's try to find you that chart. I've got it somewhere here. Actually, I mentioned this wedge today in the trading room or on the front page. I can't recall. Got to watch this. Here's what I think we might get a pullback here if that trend line breaks. Come on back in, and I think it'd be another objective entry here at 52. 522.25. These are wheat futures. Again, you can see the resistance line right here, former resistance, now support line. Have this little uptrend line with some divergence there. So this one I'd like to hold off. I'd prefer to see a pullback there and then get back into that. So we'll leave this as an unofficial trade idea for now, but that's where we've seen momentum lately. It's in these ag commodities. They're starting to catch a bid. Coffee, wheat, corn. And I mentioned to somebody in the trading room that I threw out corn as an alternative trading op. You overlay the charts of wheat and corn, they're nearly identical. They move very much in lockstep, or have recently. So you could trade one, you might as well be trading the other. If you trade both, you're overlapping your positions. So just make sure you can spread things around, but just make sure to do an adjustment downward if you have both wheat and corn in your portfolio.